if Jerome Powell looks at the conditions on the ground, especially when you start to see inflation stay in the low twos and approach 2.0, the real thing that he's going to be under tremendous pressure to justify is, why are you not cutting? And just to give you a sense of how important that is, if we cut by 100 basis points, that's another $300 billion. Now, in that case, that's not money that we get in, but it's money we don't have to spend. So if you add these two things together, we are in the next 60 days going to have to reforecast the American balance sheet where this is, or we're actually going to be able to positively forecast an extra $600 billion, $300 billion of incremental revenue and $300 billion of savings. Jason, if that happens, watch out.
What if I told you the US government is on the verge of discovering a hidden $600 billion boost to its balance sheet without printing a single new dollar? That's exactly what billionaire venture capitalist Chamath Palihapitiya is predicting. In the latest episode of the All In podcast, Chamath outlines a scenario that could change everything: falling inflation, an aggressive interest rate cut, and a sudden surge in fiscal breathing room for the US economy. If he's right, we could be just weeks away from a policy shift with massive implications for the financial markets. At the heart of this prediction is a simple question: why isn't Jerome Powell cutting rates yet? According to Chamath, with inflation approaching the Fed's 2% target, Powell will be under tremendous pressure to act. And if the Fed cuts rates by 100 basis points, a move that markets have been anxiously awaiting, it could instantly save the government $300 billion in interest payments on existing debt, a drastic reduction in expenses that will have a powerful and immediate impact on the federal budget. But that's only half the story. The other half comes from a surge in tax receipts, particularly from capital gains, which Chamath projects could add another $300 billion to the government's revenue. Together, that's a potential $600 billion swing, a number large enough to force a complete reforecasting of the US balance sheet within the next 60 days. If this happens, Chamath is predicting a massive influx of new capital into the US, which will of course be very bullish for asset prices. In this video, we'll break down exactly what Chamath means, how rate cuts, inflation, and market dynamics are all converging into a perfect storm. We'll also explore how this plays into broader macroeconomic trends, what investors should be watching, and why this next move from the Fed could ignite the markets, or send them into chaos. Please watch, share, and like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thank you, and enjoy the video.
In the early 2000s, I think that there was a war of ideas, and that there was a group of people that advocated for this reckless form of free trade and this globalist view, like every country is going to meld into one mega monolith country organization that'll get governed out of New York by the United Nations and its sleeve organizations. And that worldview won, but it was the wrong worldview. And it didn't acknowledge that we have competing philosophies, competing priorities, competing ideals of what the future looks like. And I think that we need to go back and reset all of those things. If you just take where we are, if you can just put the Sankey diagram back up, there's a couple things that are really worth noting that people need to fundamentally understand. I said a couple of weeks ago that I thought the GDP print was going to come in hot. I think everybody now is sort of where I am.
Why is it hot? Do you have a thesis on why GDP spiked so much? Or potentially did. That's obviously a forecast.
I don't know the puts and takes yet. And I think when we see the print, I have a way of forecasting this stuff, which is a bunch of signals that my team and also many macro teams all around the world, the bond vigilantes to the hedge fund guys, they all feed it to me. And what I was noticing was that we were going to come in, I said in the low threes. And I think, if Atlanta Fed is right, I don't think they are, but I think it's going to be in the low to mid threes. It's going to be meaningfully greater than what people are expecting. So let me just give you my next prediction. My next prediction are two really important things. What this Sankey diagram looks at, which is a snapshot of the balance sheet and the health of the United States in May, misses, in my opinion, two very important things that have to change. The first, and this is a positive for the Trump administration and the United States economy, is we are run rating $300 to $400 billion above forecast in terms of our receipts, meaning the revenues that we will take in. And you get to that number by looking at the last 3 months of tariffs and forecasting forward, assuming a reasonable balance here. So back to Tucker's point, yeah, we all thought that this was like a boogeyman, that you weren't allowed to touch it, and that if you touched the stove, you were going to get burned. The mathematical reality is that this is actually going to work out much better for us than we anticipated, and it's going to be somewhere in the range of $300 to $400 billion of extra revenue per year. That's a huge win. So why is that important? That then sets up this next cataclysmic thing that we're going to see over the next 60 days, which is, what does Jerome Powell do? If Jerome Powell stays politicized, his incentive will be to keep interest rates where they are. If Jerome Powell looks at the conditions on the ground, especially when you start to see inflation stay in the low twos and approach 2.0, the real thing that he's going to be under tremendous pressure to justify is, why are you not cutting? And just to give you a sense of how important that is, if we cut by 100 basis points, that's another $300 billion. Now, in that case, that's not money that we get in, but it's money we don't have to spend. So if you add these two things together, we are in the next 60 days going to have to reforecast the American balance sheet where this is, or we're actually going to be able to positively forecast an extra $600 billion, $300 billion of incremental revenue, and $300 billion of savings. Jason, if that happens, watch out. What does that mean, watch out? It means that every single risk dollar is going to run to America. Every single one.
Yum, yum.
Forget Japan, forget Europe. There is no place to put your money except the United States. So I think that we have to figure out how to get Jerome Powell on the side of America versus on the side of what could happen politically. Because I think that there's probably a version in his head that says, my gosh, if I do this, it helps Trump. And if I don't do it, it hurts Trump. Practically, that is true. But the reality is the conditions on the ground justify cutting. I believe that these decisions are political. I think that the Federal Reserve has veered away from actually controlling the money supply in the best long-term interests of the United States and more towards what benefits the short term. And this ties back to how I started this.
What is Powell's motivation?
Somewhere in the 2000s, Jason, we transitioned away from having the strategic 20-year conversation about what's in the best interests of America. And instead, we started to have these unipolar globalist conversations. And the people that got into these centers of power, the IMF, the World Bank, the Federal Reserve, the central banks around the world, they all worked towards an agenda that is now being undone. I'll give you an example of where this is now being undone. Just today, the World Bank undid a rule around being able to fund nuclear energy. And you would have thought, well, hold on a second. The World Bank steps in to backstop all these developing countries when they're in the middle of all this nonsense, right? And if you think about a country that's developing, what is the single biggest input to that country? Energy. And you think for the last 40 years of multi-trillion-dollar bailouts, we never demanded abundant clean energy in the developing world? Of course not, because it was a political decision.
To understand why this potential $600 billion shift matters so much, you have to look beyond the immediate numbers and into the broader macro picture. The U.S. economy has been walking a tightrope for months, balancing high interest payments on record national debt with slowing inflation and uneven growth. What Chamath is highlighting is a rare window of opportunity, a moment where declining inflation gives the Fed political cover to ease rates, and the markets, alongside federal revenues, respond in kind. Rate cuts aren't just a monetary tweak, they're a powerful signal. If Powell begins to cut aggressively, it tells the world the tightening cycle is officially over. This could trigger a chain reaction. Asset prices may rise, borrowing costs for both businesses and consumers would fall, and investor sentiment could shift dramatically. It's not hard to see how this could unlock a new wave of risk-on behavior across equities, crypto, and even venture capital, Chamath's own backyard. But perhaps more importantly, Chamath is making a fiscal point here, not just a monetary one. If the U.S. government can save $300 billion on interest payments while raking in another $300 billion from rising capital gains tax receipts, the balance sheet story changes. Suddenly, there's more flexibility, more room for stimulus, investment, or even debt reduction. And yet, this isn't a guaranteed outcome. It hinges on inflation continuing to drop, the Fed choosing to act, and the markets responding positively. But if those stars align, as Chamath believes they might, then the second half of 2025 could look very different from the uncertainty of the past 2 years. It's not just about cutting rates. It's about unlocking a new phase of economic momentum, one that could catch a lot of investors off guard.
Well, let me give you another data point.
Yeah.
Okay, now let's just scenario play. What happens if Powell rips in a 100 basis point cut right now? I'll tell you. So one part, which is mathematical, is the interest on the debt goes down. We save $300 billion. But there's something else that happens, which is the Fed does control the front end of the curve, meaning how do people borrow money for small amounts of time, from 1 day to about 2 years. If you make that cheaper, we know it's a test that's true as time. What happens is people borrow more money. That fuels more growth. That will end up in GDP. So what actually happens if you cut rates 100 basis points is not just the 300, but you can get this reflexive positivity in the economy. What that allows you to do is, even if that causes a little bit more inflation, you're actually growing yourself out of this whole thing. So then you ask yourself, well, hold on a second. If the numerical justification is there to lower rates, and it has all of these other positive externalities for the United States economy, why don't I do it? The only answer is political.
If you're Powell, it's better to take the risk of being Paul Volcker than Arthur Burns. I mean, that's basically what it comes down to.
Unpack that for people who aren't familiar.
Because what happened is Arthur Burns let inflation slip the leash in the 1970s, and he's remembered as a horrible Fed chair. And then Paul Volcker came in and jacked up rates to I think close to 20%, and caused a vicious recession in 1982. But by 1983, the economy had bounced back and inflation basically was under control. And then the rate cutting cycle started, and that rate cutting cycle went for 25 years. And then Reagan got reelected in 1984. So you'd rather be a Volcker than a Burns if you're a Fed chair. Now, you raised the question, is Powell political? Yeah, of course he is. If you go back to, was it 2021? So the first summer of Biden's presidency, we got that shock 5.1% inflation print in May of 2021, if my memory is correct. What did the Biden administration do? They sent Janet Yellen out to say it was transitory. And Powell got on board with the whole transitory narrative.
Exactly.
And as a result of that, he did not raise rates for 6 months. And worse than that, they continued QE. I think they bought $180 billion of bonds in that time period. And that's what allowed inflation to get so out of control. Now, why is it that Powell did that? Because he wanted to get reconfirmed. And yes, he was nominated by Trump originally, but Biden renominated him. And he basically wanted the reappointment by Biden. He wanted to get confirmed. And then the month after he got confirmed, all of a sudden he shifted gears and started raising rates again once he was safely ensconced in his office. So he did the right thing in terms of raising rates in the face of inflation once he was free from those political incentives. But for 6 months, he was intensely political, and that cost the United States dearly.
Dearly.
So now, if you're Powell, you've got PTSD from that whole experience, and you're going to err on the side of not letting inflation come back. I think with inflation down to 2.4%, I think it is time to cut rates, but he's fearful because, again, his incentives are to be a Volcker, not a Burns.
Yeah. And you want to read a good book, Paul Volcker's Keeping At It. Great book about has Reagan going to him and trying to get him to cut rates. So this is a reoccurring story just on. But
if he had done the right thing in the summer of 2021, we would never would have had that bubble at the end of 2021.
Yeah,
that basically created a huge crash in 2022. And we could have avoided a good part of that if he had done the right thing. The Fed chair, it's not a hard job most of the time. I mean, these guys sit in their ivory tower and then once a quarter they come out and do this, and basically testify and say a bunch of, things that no one can understand. But once in a while, you got to get the decision right. And he totally screwed it up in that one time where he had to get it right.
Yep.
And I would say this could be one of those moments too, where I think he's being a little bit fearful.
I think that there's a simpler explanation, quite honestly. Like if you look at Powell's history, he was nominated as a governor by Obama. Then Trump picked him out of the Fed to be chair, but then he was reappointed by Biden. If you look at the vice chair of the Fed, Phil Jefferson, he was appointed by Biden. If you look at Michelle Bowman, who's the vice chair for supervision, she was appointed by Trump. Michael Barr, appointed by Biden. Lisa Cook, appointed by Biden. Adriana Kluger, appointed by Biden. Chris Waller, appointed by Trump. So I think the point is that there is a balance of power here. If you look at political affiliations that tend to favor a Democratic view of the political landscape. And let's be honest, what benefits the Democrats more? A thriving economy and a shrinking deficit going into the midterms, or the exact opposite?
Chamath Palihapitiya and David Sachs have laid out a compelling, high-stakes scenario. A Fed on the verge of a rate cut decision, a government poised to recalculate its balance sheet, and a political backdrop that could nudge Powell toward action. Their argument isn't rooted in speculation. It's built on data, history, and a sharp understanding of how power and policy interact. And if they're right, the next move by the Fed won't just be an economic adjustment. It could be the beginning of a major regime shift. For crypto investors, this moment matters more than most realize. Historically, Bitcoin and other risk-on digital assets have surged in environments of easy monetary policy. When the Fed cut rates in March 2020 in response to the COVID crash, Bitcoin followed with one of its most explosive bull runs ever, rising from under $5,000 to nearly $65,000 in less than a year. Even in 2019, during a mild rate-cutting cycle, Bitcoin doubled off its lows. Liquidity fuels speculation, and crypto is often the first stop when excess capital returns to the system. A 100 basis point rate cut, like the one Chamath describes, would be a powerful signal that the tightening cycle is over. That signal alone could reawaken institutional appetite for Bitcoin, Ethereum, and other digital assets. Lower yields make risk-free assets like treasuries less attractive, while the promise of reflation and growth often draws investors toward high volatility, high upside assets, especially those, like crypto, that thrive on momentum. If reflexive growth kicks in and markets rally, crypto could once again serve as a levered bet on liquidity expansion. And there's another layer: political optics. If the economy improves, the narrative could shift toward technological optimism and innovation, two forces that have historically aligned with increased crypto adoption. Stablecoins, tokenized assets, and decentralized finance platforms could all benefit from looser monetary conditions and renewed venture capital interest. In short, this isn't just about rate cuts, it's about setting the stage for crypto's next supercycle. If Chamath is right, we could be standing at the edge of a massive macro pivot, and crypto might be the biggest beneficiary. But what do you think? Will Powell cave to political pressure and cut rates, or will fear of inflation keep him frozen? Drop your thoughts in the comments. Let's start a real debate. And if you want to stay ahead of the curve on how Fed policy, politics, and big money are shaping the future of crypto, make sure to like this video, subscribe to the channel, and hit the notification bell so you never miss a major update. Thanks for watching.